Recent movement in gold and silver prices has surprised many investors. Gold and silver have corrected significantly in the last week. This drop is not being presented as a normal market reaction alone. It is being framed as influenced by policy decisions and strategic actions. To understand this move, we must look beyond charts and technical indicators. The explanation points toward a larger global economic struggle. At the center of this situation is the economic rivalry between the United States and China. China is described as controlling a large share of global metals supply. Because of this control, China is said to prefer higher metal prices. Higher metal prices support what is described as a metal-driven economy. In such an environment, tangible assets like gold and silver gain strength. However, rising metal prices can hurt U.S. bonds, U.S. equities, and the U.S. dollar. A weaker dollar and weaker financial markets would reduce U.S. global influence. Because of this, metals are presented as a key battleground in an ongoing economic war between China and the United States. This is not a military war. It is an economic and financial war. From this perspective, the United States is described as wanting lower gold and silver prices. Lower metal prices help protect the U.S. financial system. They also help protect the strength of the U.S. dollar. One of the key tools mentioned in this process is the Chicago Mercantile Exchange, also known as the CME. The CME plays a major role in futures trading for gold and silver. A powerful mechanism used by the CME is raising margin requirements on futures contracts. When margins are raised, traders must put up more money to hold their positions. This reduces speculation and forces weaker hands out of the market. Margin hikes are described as a proven method to cool or control silver prices. This has been used historically, including during major silver moves in 1980 and again in 2011. According to the claim on the 29th, the CME raised margins by 25%. Then again on the 31st, margins were increased further. These actions are directly linked to the recent correction in silver prices. The idea presented is that such margin hikes may continue. They may continue until silver and gold prices cool off even more. From an investor's point of view, this changes how short-term price drops should be interpreted. These moves are not framed as random volatility. They are framed as part of a broader geopolitical and economic strategy. Investors are urged to understand this larger context. Gold and silver price movements cannot be viewed in isolation. They are connected to the wider economic confrontation between the U.S. and China. This leads to an important discussion about portfolio strategy and risk management. Diversification is emphasized as the most important risk management tool. Gold and silver should not be the entire portfolio. It should be only one part of overall asset allocation. Investors are advised to hold metals alongside other asset classes. Relying solely on gold and silver increases risk. Long-term success depends on spreading exposure across different assets. The core message is clear. Understanding economic warfare helps explain metal price moves. But protecting wealth depends on diversification, discipline, and long-term planning.
Gold and silver matter.
But balance matters more.